Hey everyone, welcome back to Corporate Decoder. Today, Fidelity Phillips Street Trust just filed its semi-annual shareholder report, and I am seeing a clear picture of how this massive fund operates. Quick note, this is not financial advice, just my take on public filings for educational purposes. This filing gives us a super detailed look at where a huge chunk of money is invested, and honestly, it reveals a lot about stability and where the cash is flowing. So this is all about the Fidelity Government Cash Reserves Fund, and the report covers the 6 months ending May 31, 2026. Basically, it's a peek under the hood of a fund that manages billions of dollars. Think of it like a report card for how this money has been handled in that short period. It tells us what kind of investments they're making and how well they're doing. Let's jump right into the heart of it. As of May 31, 2026, this fund was massive, holding over $246 billion. That's a lot of zeros. And it wasn't just in one or two things. They had 738 different investments, which suggests a strategy of spreading risk across many assets. Keeping so many investments managed well is key to a fund like this. Now, what was this fund actually invested in? They break it down by how long the investments are set to last. What we call maturity, a huge chunk, over 61%, was in very short-term investments, meaning they mature in 1 to 7 days. This is typical for a cash reserve fund because it means the money is almost always available and the risk of losing value is very low. They also had about 5.5% in investments that mature in 8 to 30 days and another 9.8% in the 31 to 60 day range. The longer term stuff, anything over 180 days, was only about 7.7% of the mix. This focus on short-term safe investments is the core of what a government cash reserve fund promises. Looking at the types of investments, the biggest slice, about 41.6%, was in repurchase agreements, often called repos. These are like short-term loans where one party sells a security and agrees to buy it back later at a slightly higher price. It's a way for the fund to earn a little extra on its cash. Next up, they had a significant amount, 30.9%, in US Treasury Obligations. That means things like Treasury bills, notes, and bonds. These are considered some of the safest investments in the world because they are backed by the US government. And finally, nearly 29.9% was in US government agency debt. This includes things issued by entities like Fannie Mae and Freddie Mac, which are also considered very safe, though not quite as safe as direct US Treasuries. The combined total of these three categories, repurchase agreements, US Treasury obligations, and US government agency debt, makes up over 100% of their net assets, with a small negative percentage for net other assets, meaning their investments were slightly more than their total assets, which is common due to how these funds are managed. Now, let's dig into the actual investments. This is where it gets really detailed. For repurchase agreements, they had a massive amount totaling over $102 billion. The table shows all the different counterparties. These are the banks or institutions they're doing these repo deals with. For example, to raise a deal with ABN AMRO Bank NV for over $335 million that matures in June 2026, collateralized by agency mortgage-backed securities. They've also got a large amount, over $10 billion, with a counterparty related to the Fixed Income Clearing Corp, collateralized by US government obligations. These transactions are short-term, with many maturing in June 2026. Then we move to US government agency debt. There are tons of entries here, mostly from federal home loan banks and federal farm credit banks. For instance, a federal home loan bank note with a 3.55% coupon maturing the 24th of June 2026 with a value of over $122 million. And we see many other notes, often indexed to the SOFR rate, with coupons just a bit higher than that, typically maturing in 2026, 2027, or 2028. This section alone is huge, showing a deep dive into the specific debt instruments they hold. And the US Treasury Obligations section is similarly extensive. We see US Treasury bills with coupon rates of 0% and maturities stretching into early 2027, like a bill maturing the 21st of January 2027, with a value of over $1.3 billion. They also hold US Treasury notes with various coupon rates, some as low as 0.625% and up to 4.625%, with maturities spread across 2026 and 2027. The detail here is astonishing, listing thousands of individual holdings, illustrating the fund's extreme diversification and focus on very liquid, government-backed debt. Looking at the overall financial health of the fund on May 31, 2026, it's pretty straightforward. The total assets were about $256 billion. On the liability side, they had about $8.6 billion in payable for investments purchased, and other liabilities brought the total to just over $10 billion. This leaves net assets at a whopping $246 billion. The net asset value per S-share was exactly $1. This is typical for a money market fund where they aim to keep the share price stable. For the 6 months ending May 31, 2026, the fund earned about $4.5 billion in interest income. Expenses were much lower, around $425 million, with the management fee being the largest component. This resulted in a net investment income of nearly $4.1 billion for the period. It's interesting to note that the entire net realized gain or loss on investment securities was a negative $53,000, which is practically zero in this scale of billions. This shows how stable and low risk their investments were during this period. The statement of changes in net assets shows how the fund grew. Over the 6 months, they had about $7 billion more in net assets from share transactions. This means more money came in from investors buying shares than people selling them. Combined with the income generated, this led to a significant total increase in net assets for the period. This indicates investor confidence and growth. Now for the financial highlights, let's look at the per share data. The net asset value stayed right at $1 throughout the periods shown, which is the goal for a fund like this. The income from investment operations, meaning the net investment income, per S-share was about $0.017 for the 6-month period. The total return for this period was about 1.71%. The expense ratio, the cost of running the fund as a percentage of its assets, was very low at 0.35% before any waivers. This low cost is a major reason why people choose funds like this for their cash. The notes to the financial statements provide some important context. They explain that the fund values its securities at amortized cost, which is a way to account for debt securities that approximates fair value. This is a standard practice for money market funds. They also mention that the fund intends to qualify as a regulated investment company, meaning it distributes most of its earnings to shareholders, which avoids paying us federal income taxes at the fund level. This pass-through of income is a key benefit for investors. The detailed breakdown of repurchase agreements is particularly interesting. It lists all the counterparties like Bank of America, NIB and Mellon Capital Markets, and JP Morgan Securities. For each agreement, it shows the value, the maturity date, and crucially, the collateral backing the deal. This collateral is typically US Treasuries or agency mortgage-backed securities. This level of detail is important for understanding the fund's risk management. One small but interesting detail is about deferred trustee compensation. It looks like some independent trustees have elected to defer a portion of their pay, and that deferred money is invested in affiliated mutual funds. For Fidelity Government Cash Reserves, this deferred amount was about $4 million. Shown as other receivables on the asset side, this filing shows a fund that is extremely conservative, highly diversified, and focused on maintaining a stable net asset value. Its massive size is a testament to its role as a safe haven for a lot of money. The core strategy here is stability and liquidity. They are investing in the safest government. Backed debt and extremely short-term instruments. The massive scale of operations, with billions in assets and thousands of holdings, is managed through sophisticated systems to ensure minimal risk. The main risk I'm watching is any significant change in interest rates that could impact demand for these types of ultra-short term and low yield investments, or a major market event that could strain liquidity, though that's very unlikely given the quality of assets. What I'm actually looking for is how they adapt to any shifts in the broader interest rate environment, because even stable funds can see subtle changes in demand and yield. Oh, and the research tools I actually use are linked in the description. They help keep this channel going. That is my take. Stay decoded. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description.